Let's go straight to our Geneva correspondent, Giovanni Stanuovo, commodity analyst at UBS Global Wealth Management. Giovanni, welcome to the podcast. It's great to have your voice at the table. You've always been a leader in the social media of spreading the good word of the energy markets for a number of years. I've really enjoyed following your work. Your thoughts this morning of these two conflicting headlines. Clearly, the oil market seems to be believing progress in Geneva. What are your thoughts?
Still Zurich-based, and thanks for the feedback. I would say generally the reason a bit the reaction has been somehow muted is that supply is not disrupted. Oil keeps flowing. And there has been a big change in market participants since 2022. Maybe you remember during the Russian-Ukrainian war, the expectation was of large disruption, which never materialized. And similar last year, when there was the 12-day war, there were limited disruptions or no disruption at all. And the market will only start to incorporate this into the prices if something happens on the supply side. We also need to remember that President Trump prefers low oil prices. So some market participants still believe that he will be cautioning. But at the same time, we see an increase in verbal tensions. If I listened to Vance yesterday, the US Vice President, he sounded less optimistic than the Iranian foreign minister. And I think we need to watch out what happens over the coming days. But what is a big difference is that the start of the year, the expectation was that the price will fall lower, and we are higher since the start of the year. So part of it is incorporated in the price, I believe.
And as we look through this immediate noise, Giovanni, of the Iran-US face-off, the talks going in Geneva, and you'd have to say generally the mood music seems relatively positive. But the other issues impacting the market, most notably Russian crude flows. Of course, Russia, one of the biggest oil exporters in the world, caught in a 4-year war in Ukraine, but still managing to get its oil to the world. But increasingly, there seems to be challenges to that. How is the widening discount on Russian seaborne crude starting to shape global oil price dynamics?
Generally, I would say these discounted barrels will ensure that there is a buyer. Essentially, it's the question how big the discount gets. Yes, it has been several times over the last 4 years temporarily difficult, but so far Russia has always managed to find a way to export its crude, and the total amount of Russian crude exports have stayed elevated. There is not a big drop unless there was an attack on some infrastructure, refinery related, impacting products, or export terminals impacting exports from crude oil. But otherwise, I must admit, I didn't expect that Russian exports hold up that well. And it's probably the same way like Iranian barrels keep flowing on the market. It's the price. If it's attractive.
When you say, Giovanni, there'll always be a buyer at these discounts, what scale of discounts are we talking about here? And is there any other buyer than China?
On the Russian side or on the Iranian side?
Russian.
On the Russian side, it's still China is the largest buyer, but India is still also buying. There is some European countries still buying Russian oil, and then somewhere in South America and in South Africa, or in Africa generally, there is still buyers, but also some Asian countries. But the majority of the flows goes to China, followed by India, although they scaled back a bit. And the discount is probably somewhere between $5 and $10.
That's all. I mean, I was hearing in double digits, but you think it's not quite in the 10 to 15 range, more 5 to 10 range.
Probably it depends on which period. When it's more difficult, it could widen, but I would say the average is somewhere between 5 and 10.
Giovanni, looking at the sort of general fund flows into oil, into commodities, Clearly, gold and silver and the metals have been big beneficiaries over the last whatever period of time you want to go back. It's been a bumper soar, but gold or oil less attractive or not drawing in similar funds, a somewhat discounted commodity, a safe haven perhaps as gold is at times. But your thoughts of where gold, the rising, what it tells us about where the funds appetite is. Can oil expect to get any of that love?
So I would make the distinction that indirectly also oil benefits from this hype in commodities. There is still some market participant buying broad commodity exposure, and with that you have also an allocation to oil, which supports also demand from there. And it's broader than just gold. It was a strong metals rally, so also industrial metal had a good performance. So it's an indirectly benefit if someone buys a broad commodity index, which contains a lot of metals, but also some energy exposure. So that's the part that can get some love from this exposure. On the gold side, clearly for me, there are two market participants still wanting to buy gold. That's central banks. Central banks since 2022, since the start of the Russian-Ukrainian war, have bought more than 1,000 tons every year, last a bit less. But this desire, despite high prices, is still there, and we still see their share of the reserves keep rising. And the latest data point was around 27% of the reserves are now in gold. In the 70s, we were at 70%. I'm not advocating we go back to that part, but clearly some central banks want to get exposure to gold with the concern on the currency markets and debt levels. The other factor is the classical investor demand. Those are looking more about the trend on the central bank policy. We already heard Peter mentioning the desire in the Trump administration to see lower interest rates in the US, and that will support ongoing demand for an investment community. And I still believe that there is more upside for gold, and we are targeting a price increase towards $6,200 an ounce.